Asian equity markets experienced a remarkable recovery in the June quarter, paring back most of the losses incurred in the first 3 months of the year. Absolute returns were the best in over a decade in US dollar terms, leaving the region down around 5% in the 6 months to June. While there was no one central reason for the sentiment change, massive central bank intervention and new government spending programs, as well as hope around the trajectory of COVID-19 infection rates, all contributed. However, with the global economy experiencing one of its sharpest downturns in history, with many economies contracting by double digits on an annualised basis, some caution is clearly warranted. Despite the positive shift in sentiment, frustratingly there was very little change in market leadership, with those stocks outperforming in the downturn also leading the upturn. Market concentration has been a major trend in 2020 as the number of stocks outperforming the benchmark approaches historical extremes. This cohort driving markets higher is made up of a number of large cap, high growth companies where forecasted profits and prevailing valuations offer very little margin of safety. Indeed, much of the outperformance of growth over value has been driven by expanding valuations, such that growth stocks sit at more than 20-year highs, while the cheaper parts of the markets are languishing at 20-year lows. History is instructive in times such as these. While the timing can never be certain, these conditions do not last. With concentrated investor positioning and valuation dispersions at record levels, the makings for a significant reversal are in place. As the economic recovery continues, we expect this market narrowness to widen considerably to the benefit of both absolute and relative returns of the portfolio. The passing of the Hong Kong National Security Law during the quarter was a significant event and has the potential to be a pivotal moment for the territory's future. Frustrated by previous attempts to pass similar legislation, as well as a growing unrest in the city over extradition laws proposed last year, the Chinese government bypassed Hong Kong's Legislative Council to implement the law. From a practical point of view, it's too early to tell whether this proves to be the end of Hong Kong's independence and its one country, two systems operating model, or simply a long tail risk, with economic activity returning as usual post-COVID. Relations with the US have been impacted, with the Trump administration seeking to end its preferential treatment and also set to impose sanctions. Yet Hong Kong's relevance to both China and the region is unlikely to disappear anytime soon. Certainly its significance in capital markets continues to rise as Chinese companies listed in the US look for an alternative listing. Both NetEase and JD.com undertook successful secondary listings in the quarter, with more expected to come. Meanwhile, it remains a key part of China's strategically important Greater Bay Area initiative, seeking closer economic ties with cities in the wider region. Looking ahead, while uncertainty around a range of issues remains high, we are positive on the Asian region's prospects and for a value-oriented strategy. Many of the stocks in the portfolio at present trade at record low valuations, offer attractive dividend yields on what are generally depressed earnings. With an improving economic backdrop, returns are likely to be enhanced not only by higher earnings, but also higher valuations ascribed to those earnings as investors reassess the outlook for this segment of the market.